Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1238A, and today's date is March 26, 2017, and the title of the episode is The Economic Volcano is About to Blow. Now, before I get started, I just want to make an announcement. I uploaded an interview with John Rubino. It's on the X22 Report Spotlight YouTube channel. So all you need to do is go to YouTube, type in X22 Report Spotlight. It will bring you right to the video. Or you can come over to the X22Report.com site, scroll down a little bit, look over to your right-hand side. You can play the video right on the site. Or you can go to newssentinel.com. Same thing, scroll down a little bit, look over to your right-hand side, and you can play the video there. Let's get into the economic collapse financial news. Now, as we've been following this economic crisis, as we implode into the economic collapse, we've been following a lot of the economic indicators, and we are seeing they are continually getting worse as time goes on. And what we're seeing now is things are really starting to accelerate. When we look at store closings, we are continually seeing more and more of these brick and mortar stores that are closing now. GameStop is closing about 150 retail stores in 2017. We understand the first half of this year, there's going to be about 3,500 stores closing. And we need to think about what is happening here, because as they close these stores, remember how they calculate retail sales. They don't just cut them off and stop them and say, okay, retail has just stopped. They wean them off over time to make it look like the economy is still chugging along. So in reality, the economy is doing 10 times worse than what they're really saying, because when the store closes, that's it. The sales stop. I mean, we see Radio Shacks, they're pretty much done. Sears, done. JCPenney's, done. Payless Shoes, done. All these stores, they're just continually closing. And a lot of individuals are looking for work and they cannot find jobs. And what we're seeing at this point is that there are so many indicators showing us and flashing a red signal saying we are in a recession. We are in a recession. Now, we can see by looking at housing, we can see by looking at the auto industry, we can see by looking at the GDP numbers, we can see by looking at what's really going on, we can see that things are rapidly breaking down now. And there's no stopping it. It's just going to continually break down. It doesn't matter what the stock market does. It can go to 1 million at this point. Because when most of the stores are closed, when GDP is in negative territory, and people are looking for jobs, and the debt ceiling is hit, and even if we take on more debt, it makes no difference because we're stuck in the same situation. Subprime auto loans, and this was a big force behind the booming car sales in recent years, are getting crushed by defaults. It always comes back to haunt you later on. Everyone thinks, oh, look, the economy's doing well. Look at the car sales. Look at this. But you have to look at the underlying factor of why this was driven and why it has been pushed so high. I mean, think about 2006, think about 2007, even going back to 2005, even further back than that, when everyone was looking at the housing market going, wow, look, it's really doing well. People thought their houses, they bought houses at 400,000, 500,000. They thought it was going to go to 1 million, 1.1 million, and then all of a sudden the housing market crashed. The reason for that is because no one was looking inside of what was really going on. What was the underlying motive of pushing all this up? And no one really looked at that. They didn't realize that the underlying motive was fake, phony, and false. It was a house of cards. And once that was taken away, the whole thing was going to come crumbling down. This is what's happening right now. And those loans that were originated between 2013 and 2015, I'm talking about the automobile loans, these are all subprime loans, they were surging because the underwriting standards became, loosey-goosey. And we can see what happened was they were doing the same thing as the subprime securities in real estate. Auto lenders repackaged their loans into asset-backed securities, ABSs, and they sold them as bonds to yield-hungry institutional investors. Fitch Ratings, which rates auto lenders and auto loan ABS, just reported on the state of the industry. The Fitch Auto ABS indices show that 60-plus day delinquencies were relatively low for prime auto loan at the end of the fourth quarter, but the subprime loans, they've surged to 5% of outstanding balances, the highest since 2008. Now, net charge-offs show a similar scenario, only worse. Net charge-offs from prime loans ticked up to still low 0.75% of these outstanding balances. But net charge-offs from subprime loans surged to 10.5%, the highest since 2008. Now, why is this so important for the industry as a whole? Not just lenders and their investors. Lenders are starting to feel the bite of those losses that are made worse by extending loan terms, higher to loan value ratios, a higher proportion of subprime loans, more negative equity for longer, and hence the subprime defaults and net charge-offs that are soaring to crisis levels. So they're feeling it right now. And if we look at the housing market right now, we see pretty much the same thing is going on that we saw back in 2007 leading into 2008, where speculators who were flipping and buying these condos and doing everything they were doing to make a buck, well, everything is starting to plunge right now. Miami-Dade's spectacular condo flipping mania, well, right now it is in turmoil. Sales are plunging, inventory for sales soaring, and new supply flooding the market. It's not like Miami hasn't been through this before. It has. People just don't remember. They think, oh no, this time it's going to be completely different. No, it's not. It's the same exact thing. In February right now, existing home sales of all types fell 10% year over year. These sales do not include Miami's multi-billion-dollar new construction condo market. This new construction market that is not included has become distressed. Sales of single-family homes fell 10% in February. Condo sales fell 10% as well. Now, there's a chart by Stat Funding, and it shows the plunge in sales and the surge in condo listed for sale. And it is absolutely awful. I mean, it's negative 25% down. It's terrible. And the 12 largest development completed between 2015 and 2016 have added about 2,700 condos to the market. Developers still own 433. That's 15.8% of them. In addition, pre-construction flippers are also trying to unload their units. In those 12 developments alone, 451 condos, or 16% of the total, have been listed for sale on the MLS for a very long time, and they cannot move it. We have been seeing this. This is consistent of what we saw before, and it's starting to ramp up now. It's getting worse. And as we move throughout the year, this economic volcano, it is going to blow. Because the situation is not just going to automatically improve. I know people are hoping it's going to improve. I know people are saying, yes, things are going to get better. But as we can see, the Fed has already marked that interest rates are going to be moving up. We already see yields on bonds. The interest is moving up, which means the mortgage rates, well, we're seeing it right now. They are moving up, which means mortgage applications are going to decline, which means sales are going to decline, which means prices are going to come down, which means sales are going to come to a screeching halt, which means all these speculators that are out there, it's going to be a complete disaster. So what we're looking at right now is a complete disaster of the system. This economic volcano, it's getting ready to blow. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.